Hello everyone. Today's video will focus on ICT mitigation blocks, including how to identify and trade them. Mitigation block occurs when there is a sudden shift from bullish to bearish momentum or vice versa, indicating a potential market reversal. This shift can create exciting opportunities for traders seeking high-risk, high-reward trades. In this video, we will explore what a mitigation block is, the essential rules for applying it on a chart, and how to integrate this concept with other smart money principles for identifying high-quality trade opportunities. If the previous video on breaker blocks was missed, a link is provided in the top right corner, as the concepts are closely related with one key distinction. If this sounds interesting, please support the channel by liking this video and subscribing if you're new. Let's dive in. To start, what exactly is a mitigation block? The concept refers to a reversal pattern where the price momentum changes direction abruptly. A mitigation block is a failure swing that occurs when price fails to swing higher or lower in bullish or bearish market respectively. Smart money buys during bearish candles and sells during bullish candles. When smart money buys within a certain zone, the price may rise slightly, but if it breaks the previous low of that zone, a shift in the market occurs, indicating a structural change from bullish to bearish. Smart money needs to bring the price back to the last point where it made a purchase in order to open a new sell position or to close its existing buy position. When the price returns to the reference buy point A, the long positions that were opened during the price movement from A to B have the opportunity to either exit their long positions or enter short positions. This situation can lead to a price movement to retest point C, or the price may continue its downward trend until it reaches the next support level. This short-term price rally from A to B refers to one of the key price reference points known as a mitigation block, the last red candle. The key difference between a mitigation block and a breaker block lies in their structure. A mitigation block consists of low, a higher low, and then a higher high. In contrast, a breaker block features a low, a high, a lower low, and then a higher high. The defining difference is that a breaker raids liquidity on its respective timeframes by making a higher high or lower low before reversing, whilst a mitigation block does not do that. For this reason, a breaker is always a higher probability PD array to trade off from. Now, let's analyze the pound-dollar on the 5-minute chart. Initially, we see an upward trend on the chart. After forming higher highs, the price could not break the previous high and created a swing failure. Once the failure swing is created, the market suddenly shifts direction after confirming a new lower high, moving downward. Eventually, the price breaks and closes down the low of the last bearish candle, marking a significant change in market structure. Following the swing failure, the market broke the upward structure, leading to the formation of a mitigation block. We mark the last bearish candle before the swing failure and wait for the price's reaction to it. This area now qualifies as a valid bullish mitigation block, signaling that buyers in this zone have been stopped out. With the bullish market structure shift, leading us to anticipate price rejection from this mitigation block and a continuation of the downward movement. As observed, the price initially moves downward and pauses momentarily within the breaker area. After accumulating more sell orders, it gains momentum and pushes downward. However, it's important to note that not every mitigation block pattern you see on the chart will lead to a successful trade. Especially if it occurs in the middle of nowhere with no clear structure or context. To trade mitigation block effectively, it must align with other market factors and conditions through backtesting. We have realized that mitigation block patterns are most effective when accompanied by specific conditions to ensure a valid block, and to enter a high-quality trade certain rules need to be followed. So let's discuss the key conditions that enhance the reliability of a mitigation block pattern. One of the confirmations that can enhance the validity of a mitigation block is the formation of an SMT or smart money technique with the correlated assets of that symbol. I prefer to consider trading mitigation blocks when there's a smart money technique. This means that another instrument has a breaker here, which should not see this low. 2. Rejection at a higher time frame key level. As previously mentioned, The mitigation block is a reversal price action pattern that gains effectiveness when it occurs after the price has interacted with a key zone on a higher time frame. Key levels on higher time frames, such as the 4-hour, daily, or weekly charts, have a significant influence on price movements. When the price reaches these zones and a mitigation block forms, it suggests that a market reversal is likely at a critical area, thereby increasing the pattern's reliability. Without this higher time frame confluence, a mitigation block may occur in areas where the market is less likely to experience a meaningful shift, diminishing the probability of a successful trade. Formation of reverse FVG. The price should be able to create a fair value gap, or FVG, in the opposite direction. When a mitigation block forms alongside a fair value gap, it provides a clear indication that institutional traders or significant market participants are driving the move, adding further credibility to the setup. A price retracement into the fair value gap can present a high probability entry point, as the market often fills these gaps before continuing in the direction of the new trend. By combining volume, fair value gaps, and mitigation block, traders can significantly enhance the likelihood of a successful trade while minimizing risk. Time and bias confirmation. As with any trading strategy, we always look for confirmation in both timing and market bias. For example, look at this chart. In this time and session, you see a lot of fake mitigation blocks because the time and session are in the Asian range. Unmitigated mitigation blocks. Mitigation blocks are considered one-time use, meaning we only seek trading opportunities when the price first interacts with a mitigation block. To integrate all the criteria and rules for identifying valid mitigation blocks, let's take a look at a real chart example. Here we have a downward trend that has reached an important zone on the 4-hour chart. After the price reached this zone, a swing failure was formed, which increases the probability of forming a mitigation block for us. After price moves by creating higher highs and higher lows and the market structure shift created, a mitigation block was formed, and with the formation of a fair value gap, the validity of this mitigation increases for us. In the FVG and mitigation block zone, we place an order to be ready to follow the price direction if it moves upward. The price returns to our order, and after the order is activated, it gives us to take profit. Okay, if this video was helpful, please give it a thumbs up, as it greatly supports the creation of more content like this. Thank you for watching, and see you in the next episode.